Silicon Valley Bank has now been marked as the second largest bank failure since Washington Mutual went under in 2008. And they just announced that another bank has gone under, and that is Signature Bank out of New York. Just today, the government has announced that they are essentially, even though they don't want to say it, bailing out both of these banks by ensuring that all depositors, so for example, the companies that had their money in Silicon Valley Bank or in Signature Bank, will have access to all of their money come Monday. But kind of going off of the last video we did, why did Silicon Valley Bank actually fail? 3 short days it went from a bank to absolutely closed, and a lot of chaos over the weekend after March 10th. Going back to the movie, It's a Wonderful Life, there was a huge what we call bank run that occurred in that movie that caused chaos for George Bailey.
Don't look now, but there's something funny going on over there at the bank, George.
So just like George Bailey, Silicon Valley Bank didn't have all of its cash back in the safe. So to start, let's go back in time a little bit. Back in 2019 and 2020, when there was an influx of cash coming into Silicon Valley Bank, a lot of startups, in fact, this was called the startup bank, that grew them to over $342 billion in total client funds at the end of 2022. So with that influx of cash, Silicon Valley Bank, well, they want to make money in the process. Now, what they did, instead of investing it and going all in on something like AMC or GameStop, they decided to go with a safe investment called government-backed mortgage securities. But then again, how does that come to a point where regulators come in and actually shut down the bank? So let me give you an example. Right here, you have the bank, and then you have mortgage-backed securities that Silicon Valley Bank was also buying. Now, mortgage-backed securities, they tend to have a maturity date 10, 15, or 30 years from today. But the beautiful thing about that is you invest that money for 30 years, for example, it grows at a fixed interest rate. So whether that gets paid out quarterly, monthly, or yearly, you're making a guaranteed fixed rate return on buying that security. The risk to that is when interest rates rise. So let's say, for example, you decide, and I'll make these numbers very low so it can make a little bit more sense. We're not going to talk about millions and billions of dollars. Let's just talk about an easy $100. So you decide you're a startup company and you got some lending. So you have $100 in lending, and you want to take that money and you want to store it away in a bank. So you take your $100 over to Silicon Valley Bank and say, hello, I want to deposit my $100 right here into the bank. Silicon Valley Bank says, you look like you're a good, trustworthy startup company. Go ahead. Let's open an account and you'll deposit that money. So you now are the depositor and SVB is your bank. Now, SVB, they want to make some money too. That's how banks make money. They basically make money on the interest rates. So they take that $100 and they invest it in a 30-year, so this is a 30-year government-backed mortgage security for $100. So now your funds are sitting in a mortgage-backed security. And the rate was 1.75% at the time that they bought, and that's a fixed rate, which means it's not going to go up, it's not going to go down. It literally stays at 1.75 until the maturity date 30 years from now. Now, everything's usually fine if it stays at that 1.75 or lower. The issue is, because the interest rates have gone up over the last 2 years, now we're looking at about a 3.9% interest rate. So there's a little bit of a difference. Let's say one cold, rainy day, you come walking in and you say, hey, things aren't looking well. I'm going to have to withdraw more money than typical. In fact, I'm going to have to withdraw all my money. Now, we're only talking about $100, but think about it a little bit more grand scheme. You have a lot of different startup companies, and maybe they're having a little bit of an issue in 2022 because maybe the economy is softening. So they're gonna have to pull out some more money. They need to maybe, pay their employees, or maybe they're like, oh crap, we're having some other issues with debt and we need to pay that debt off. We need to take our money out of the bank. So they start saying, hey, SVB, I need my money back because you're a bank and I'm withdrawing my money. It's very simple, right? Just like we go to the bank and withdraw our money. Problem becomes, now what they have to do is sell their mortgage-backed security here at a higher rate, which means because it's before the maturity date, this might actually be a lot less than what it was when you initially bought that security. Because again, we're talking about a 30-year maturity, very long time to build up that. Now, I'm not saying everything was 30 years, but just in this example, it is. So now they may only get back maybe like $90, or they may only get back like $50, and they got to figure out, okay, well, I need to give you back your $100, so I need to make up the difference as the bank to make sure you are whole again with whatever you're trying to withdraw from the bank. Uh-oh, that's a bit of a problem. And because there's something called a cash burn, which means not just you, the startup company, but other startups companies were having some issues too in 2022, that they started withdrawing some money, and then it became a little bit of a, uh-oh. A lot of people are withdrawing. We're gonna have to figure out a way to make up the difference. So in order to do that, we need to raise more capital. Now, what that means is the bank needs to make more money to obviously offset the difference. So what they do is they start issuing maybe more shares of stock. They try to find, some capital investors, things like that. But then things get a little bit nerve-wracking because they announced that. And that's what happened on Wednesday. The CEO comes out and says, hey, we have a little bit of a cash burn situation going on. People want their money back. Startups are wanting their money back. And we're going to have to offset, a little bit of a screwed up point. Other companies start getting worried. Other startups are like, hey, wait a minute. Are you saying that you're not quite there? You don't have a lot of money? There might be an insolvency issue here. I'm scared. Let's go pull out our money too, just to be on the safe side. Well, now they're even more screwed. And that's what the term bank run comes from. And that's exactly kind of what happened with It's a Wonderful Life. Everybody started rushing in and it's like, no, I don't have the money right here. There's a bit of a process to this. And because there's so much fear rushing in at the same time, pop goes the weasel. And that's exactly what happens. If it wasn't for the government stepping in, some companies were gonna be in big, big trouble. But now the question becomes, what is the next concern that we need to keep our eye on over these next couple of weeks? What we don't want to see though is what we call a contagion effect. Contagion effect is ultimately like the spreading of a virus. There was actually a movie, I think, called Contagion, and it talked about a virus spreading. That's what could potentially happen here that we don't want to have happen over these next couple of weeks. Let's say there's some other people that get a little bit nervous. Could be just your everyday Joe. It could be other companies, and they go to the bank and create another bank run. Well, now we're in a little bit of an issue because these other banks are going to be put to the stress test as well. And as they always say, when you're out there swimming in the ocean and the tide goes back out, we get to see who was swimming naked that entire time. So it's really important that hopefully these regional banks, these smaller banks, and these startup banks like Silicon Valley Bank have some type of diversification, or some type of offset to keep them floating when times get tough. Otherwise, the FDIC and the government's going to be put to an interesting test, because at the same time that they're trying to fight inflation by raising interest rates, there's now this issue. We could be seeing quite some turmoil in the economy over the next couple of weeks. Not to spread any fear, it's just really, really important to stay informed so you can know exactly what turn you want to make next. Now, keep in mind, even though the government is coming in to help depositors get all their money back that were banking with Silicon Valley Bank, this does not protect investors. Stay tuned for more. Watch this video next. We'll see you on the next video.